regular Insight viewers recognize her right away as a valuable resource in planning and sustaining your retirement. She's Heather Foster, investment advisor and fiduciary. Today we're going to talk about the taxation of annuities. So we want to use annuities in our retirement planning, but it's important that we think about how they're going to be taxed, yes?
Yes. So obviously if you watch the show, I talk a lot about Roth conversions. And there's a reason why I talk about Roth conversions so much is because, again, you're tax deferring things, right? You're saying, hey, I want to pay taxes later on things like your IRA, your 401ks, instead of paying them now and letting them grow tax-free. So we talk a lot about that. But I've not really hit on the fact that non-qualified annuities do the same thing essentially, right? So non-qualified simply means the money is not supposed to be qualified to be taxed. However, that's the base of what you put inside of that annuity.
Okay.
All right, so a non-qualified annuity is usually generated, say, like you take money out of your checking or savings, you write a check to an annuity company, that's after-tax money going in. Now, the key is you're saying to that annuity company, I want to shelter the growth, right? The growth I don't want to pay taxes on as I move along through the road in my retirement. Instead, I want to look the other way again and pay those taxes later, or upon my passing, my kids get the money, that kind of thing.
And they have to pay
right?
them.
So it's called tax deferral. The issue I'm running into when I'm laying out plans for people again is, all right, do you really want to defer the taxes? So I meet people that maybe they bought a non-qualified annuity years ago. Let's say there's $40,000 or $50,000 of gains inside of it. Again, most people are not aware. Annuities work a little bit different than like a brokerage account. If you had put $100,000 into a brokerage account and it made $50,000, you're looking at what we call capital gains.
Right.
Capital gains are taxed at 0 sometimes, depending on your tax bracket, 15%, and there's a higher bracket too, 20%. Ordinary income, which is things like withdrawals from an IRA or withdrawals from a non-qualified annuity, those earnings, that $50,000 is taxed as ordinary income.
So whatever your tax bracket is,
that's what you're going to get taxed on it at, okay? And you can't avoid it. But with after-tax money that in a brokerage account, let's say we made that same $50,000, we can strategically pull that money out. If you're in a low tax environment, you may pay 0 capital gains. However, the annuity money that it generated, that same $50,000, you will pay taxes on it at your ordinary income. So would you rather potentially pay, again, no taxes?
Right.
Or would you rather pay ordinary income taxes? And this isn't just for you, this is now for your kids too. So again, if you're saying, hey, I want to look the other way, I don't want to worry about the tax or the earnings on this annuity right now, my kids will deal with it. Your kids certainly will deal with it at their ordinary income tax brackets as well. The only time I normally put after-tax money into an annuity for strategic purposes, if you're living on the income on a regular basis, I feel like that's okay, or if the money is set to go to charity. Okay, because charities can get it differently. So
you've talked about how we can give money from IRAs and the other things.
There are charitable annuities out there. There are ways to give the annuity money and that big gain to charities as well. So if it's not one of those two reasons that someone's doing it, I don't know that a tax sheltered plan for after-tax money is a good idea. Again, everybody's a little bit different, but from what I'm seeing, I've switched some of my clients. We've got enough done in Roth conversions to keep their required minimum distributions low enough to always keep them in a low tax bracket. That's step 1.
Yes.
Step 2 for some clients that had existing annuities that maybe they bought many, many years ago is now I'm going in and strategically pulling out maybe $10,000 a year that they can get out in this low tax environment, repositioning it into a brokerage account. Therefore, the gains that we now earn are capital gains. And again, because I'm keeping them in a low tax bracket, capital gains rates 0. So again, if you're not working with somebody this is intensive planning. This is not, light level stuff. This is where we start to get into concept theory on, okay, if we do this now, what will it save you long term when we're looking 10, 15, 20 years down the road, especially to the inheritors or the kids. So make sure you understand if you own an annuity, did you put IRA money into that annuity? Did you put after-tax money into that annuity? If you put after-tax money into the annuity, do you have a tax plan? Because there is something called LIFO, FIFO, and pro rata.
I know what none of those mean.
Fun terms, right? But that's how the money actually comes out of the annuity. If it's last in, first out, first in, last out, or if it's a mixture of the two, you need to understand how the money will come out. So if you ever went to that annuity and said, hey, I need $20,000 out, is all $20,000 taxable? Is it a portion? Or is none of it taxable? You need to understand those things.
Well, it's just one more reason we need to have a retirement plan and a tax plan. If you would like Heather Foster at Foster Financial to go over your plan with you and look at all those possibilities, all you have to do is give them a call.